Greetings to you all. Welcome you all to Chatmaster FX. Your boy Chatmaster here. Today we are going to look at the failure to return to supply or demand, which is abbreviated as FTR2SD. So this is one of the major comrades, and we are going to explore the standard operating procedure. Let's go straight to the anatomy of the FTR2SD. So this is the anatomy of the FTR2SD. So guys, you can see that here we had a drop in price. So this is what we call the supply zone. So once you have a drop, you can be able to mark your supply zone. Once you mark your supply zone, we can see that the price went here and created a cap. Once the price created a cap here, it actually created a drop base rally. So when it created a drop base rally, the market failed to come to the supply zone. So this is what we call failure to return to supply zone. So once the price fails to return to supply zone, then you can be able to draw what we call the light tunnel. Once you draw the light tunnel, you wait for this base or this cap to be engulfed. Once this cap has been engulfed, then when the price comes back to the light tunnel, then that's where you can be able to place your trade here and possibly put your target profit here on the depth of engulfment and put your stop loss just above the supply zone. So there's this scenario that actually happens as well, where we can be having a drop base drop. So once you are having a drop base drop, what usually happens is that the price may drop for a little bit here, and the price comes to supply zone, but it fails to come to the supply zone. So it actually creates a FTR to supply here, which is what we call failure to return to supply immediately after the price has actually created a base here. So your FTR to supply may be at this immediate point. So, or it might come after a while the price is created a cap area to the downside. So guys, this is how you can be able to spot the FTR to supply or demand on the live market. So guys, the first thing that you need to see or to spot in the market is the supply zone. Once you have a supply zone, the price fails to reach to the supply zone. And once the price fails to reach to the supply zone, then you can be able to draw your light tunnel. Once you have a light tunnel, then you wait for the price to engulf this cap area. Once the price engulfs this cap area, then the price needs to come back to the light tunnel. Once the price comes back to the light tunnel, that's where you can be able to place your trade. So let's go to the terms and conditions for a sell setup. As you can see, guys, that for the sake of simplicity in this standard operating procedures, we are going only to look for a sell setup so that we make things simple. And once you master the sell setup, it might be easier for you to master the buy setup. So guys, these are the terms and conditions for the FTR to supply or a demand. So there should be a failure to return to supply, as you have seen previously, that a failure to return to supply must be there. That's one of the conditions that you must be having. And the light tunnel should not be significantly large. to minimize risk. So this is what we are saying, guys, that as you can see that when the price failed to come to supply zone, as you can see, our light channel is not significantly large, and this is one of the conditions that you need to make sure that it has been met. This actually helps you to minimize risk, because if you may have a failure to return somewhere here and your light channel is great, then you have a problem. You have a problem because if the market reacts against you, it means your stop loss will be here. So once your stop loss is hit, then you have lost a lot of money out of there. So you need to make sure that your light channel is significantly low. The light channel should not be large. It should be very, very small, so that you can be able to minimize risk. So that's what we are saying here. And the demand should be tested at least 2 times before engulfment. So this is another condition, guys, that you have to make sure that it has been met. So before the demand has been engulfed here, you need to make sure that the price is able to test this demand zone at least twice. So the price must come here for the first visit, then it goes and it comes back for the second visit. Once we have at least 2 visits, then you can be able to qualify this as a valid FTR to SD. So once you have that condition, then you can be able to place a trade from here. So that's another condition that you need to make sure that it has been met in order for the conditions to be considered valid. There should be engulfment of demand. So as you can see here, that the demand was finally engulfed. Once the demand has finally been engulfed, then you wait for the price to come back to the light channel. Once the price comes to the light channel, then you can be able to place your trade from there. Then your take profit will be here, your stop loss above. So take note that once you have a demand and you have 2 visits to this demand, then that's where you wait for the price to engulf the demand. Once you have the condition of engulfment, then you wait for the price to come to the light channel, and you can be able to place your trade in the light channel. Then once that condition and all the other conditions have been met, then you can be able to consider the conditions of the FTR to SD to have been met. So entry, place a trade on the light channel. I have alluded to this before. The stop loss should be above the supply zone. The target profit should be at least at the lower low created after engulfment of demand. So as I have said, this must be your safest target profit. So let's go to chart examples. So in chart examples, guys, here we are on volatility 25-1S index on the H1 time frame. So as you can see, guys, here that we have a demand here. So you mark your demand zone. Once you mark your demand zone, then you wait for the reaction of price towards this demand zone. And as you can see here in example number 1, the price actually came to test this demand for the first visit. Then the price came back again for the second visit, and now we know that the condition of price visiting the demand zone has been met. Then before the price engulfed this demand, guys, you can see, guys, here that we have an RBD, which is what we call a rally base drop. So here we can see that the price failed to come back to the RBD. It failed to come to this cap area. So once the price fails to come to this cap area, then we can be able to draw our FTR to supply, failure to return to supply. Then you can draw your light tunnel. Once you have your light tunnel, you wait now for the price to engulf the demand zone after at least 2 visits. Once we have that condition, then we know that as the price comes back to this light tunnel, then that's where you can be able to place your trade here and put your stop loss just above the cap area of the RBD. So here your target profit will be here, which is the depth of engulfment. So here that's where you can be able to take your profit. So this is example number 1. So let's go to example number 2. So in example number 2, we are on volatility 25 index on the H4 time frame. So guys, as you can see here, we have a demand zone, and this demand zone is coming from a rally base rally. So once we have our demand zone, we wait for the reaction of the price on the demand zone. As you can see, guys, that there was a first visit here to demand, then we had the second visit here to demand, then we had the third visit here to demand. So here we have at least 2 visits to demand. So we know that one of the conditions of the FTR to SD has been met. So once we have that condition, we can see, guys, that here we had our supply zone. So having our supply zone here, we can see that as the price was coming down before it actually engulfed the demand zone, we can see that the price actually created what we call an FTR2 supply. So as the price failed to come back to the cap area of the supply zone, we can see, guys, that a light tunnel was created here. So once we have a failure to return to supply, then that's when you can be able to draw your light tunnel. Once you have your light tunnel here, then you wait for the price to engulf the demand. Once the demand is engulfed, then as the price approaches the light tunnel, then that's where you can be able to place your trade and put your stop loss just above the supply zone. So take note that to increase the probability of success of these trades, if you have a PA, a price approaching towards the light tunnel, then it actually makes that trade to be more probabilistic in nature. You increase your chances of being successful. So you can see here, guys, that we had a compression of price as the price was approaching the light tunnel, and finally as the price reached the light tunnel zone, it was able to drop. And here, which is the depth of demand engulfment, that will be your safest take profit, and you put your stop loss just above the supply zone. So once you put your stop loss above the supply zone, then you would know that you are more likely to be successful on this trade because all the conditions are met, and an additional condition has been met, that we have a PA. So once you have a PA, then you are actually increasing your chances of success because it is a confluence. But you can take a trade even though we don't have a PA when it comes to FTR to SD. But when you have a PA, you're actually increasing your chances of being successful in that trade. So let's go to example number 3. So in example number 3, guys, here we are on volatility 25 index on H4. So guys, as you can see, guys, the first thing is for you to identify your demand zone. So here we have our demand zone, and the price is actually coming from a drop base rally. So here, guys, you can see some multiple tested FTB here. The price tried to visit here, visited here, visited here, visited here, and finally the price was able to engulf this demand. So once the price was able to engulf this demand, you can see, guys, that this demand was created after we had already experienced our supply zone here. So you can see that there is a little change in this example. As you can see before, the supply here was actually created after the demand zone, and on example number 1, you can see that this demand was created before the supply zone. So here you can see we have our demand. The RBD, which is supply, was created after the demand zone. So this is another version of FTR to SD, where you can see that this demand can be created after we have already identified the supply zone. But usually best examples are like this, where the supply should be created after the demand zone, not in this case where the demand was created. You can see when the supply was created first before the demand zone was created. But usually, even on such kind of setups, it works well, especially when you have a PA, the market to work for the best. So you can see, guys, that we had a first visit here, second visit, a third visit here. So finally the price was able to break this demand zone. Once the price broke this demand zone, the price approached the FTR to supply in the form of a 3D, and also we had a compression here. So here is a price approaching. So once you see a price approaching, you're actually increasing your chances of being successful in that trade. So we have a FTR to supply here, which is your light tunnel. So we have our light tunnel, and you put your stop loss just above supply, and your surface take profit will be here, which is the depth of engulfment. So you take your partial profits here, and you may leave some of the trades to run. So guys, that's example number 3. Let's go to example number 4. So in example number 4 here, we're in volatility 25 index on H4 time frame. So guys, you can see here we have our demand zone here. So we have our demand zone, and supply was actually created after the demand zone. So we have our supply here, guys, and you can see that this demand was tested multiple times. We have this first visit, we have this second visit, we have this third visit. So we can see that that condition of visits to demand has been met. Once we see that, we wait for the price to actually create a supply zone to the upside. So here we draw our supply zone. Once we have a supply zone here, the price failed to come to supply zone. So once the price fails to come to supply zone, we can be able to draw our FTR to supply here. Then you draw your light tunnel. Take note that the light tunnel should not be significantly large, because once you have a light tunnel that is significantly large, you actually increase in your risk. So you have to lower your risk. So how do you lower your risk? You need to only take trades that has got a light tunnel that is very small, like this one. So finally the price was able to engulf this demand. Once we see an engulfment in the demand, we wait for the price to come back to the light tunnel. Once the price comes to the light tunnel, then we can be able to place a trade. Here we had no price approaching, so even though we don't have a price approaching, we can still consider taking a trade. As I have alluded before, that when the price comes back to the light tunnel, it actually just helps you for confluence. Once you have a PA here, then you know that your chances of being successful in that trade is very, very high. So you put your stop loss just above the supply zone here, and the surface take profit is the depth of engulfment before the price came to the FTR to supply. So you can take put your surface take profit here. So let's go to example number 5. So in example number 5 here, we have our demand zone here. Once we have our demand zone here, we can see that the supply zone was created on the upside, and you can see, guys, that we had an FTR to supply. The price failed to come back to the supply zone. So here you can be able to draw your light channel. Take note that the light channel should not be significantly large because you'll be increasing your risk. So if you had a light channel that is so big, then it's better not to take that trade and only take trades that has got a light channel that is significantly small. So here, guys, you can see that this demand was tested multiple times. You can see the first visit here, the second visit here, and the third visit here. So once we had all these visits, then we wait for the price to actually engulf the demand zone. So this demand zone was actually engulfed. Once the price actually engulfed the demand zone, then we wait for the price to approach the light channel zone. So as the price was actually approaching the light channel zone, it actually approached it in the form of a 3 drive. And also we can see here that we had a fake out. As you can see that there's a notable resistance line here of 1-2 touches. So once we have a notable resistance here, we can see that when the price came to that same area, it was able to break the resistance line in a form of a fake out. So here, guys, we have a price approaching, we have a 3D, we have a fake out. So these guys increase the chances of being successful in that trade. So it's a form of a confluence. So once you see that there's a confluence, then you know that you are actually increasing your chances of being successful in that trade. So guys, these are the examples of the failure to return to supply or demand. So here, guys, we only look for sell set up, but just for the sake of simplicity, but you as the mentees, you are obliged to also look for some buy set up, but it actually encouraged that you need to look for the sell set up first. Once you are familiar with that, then you can be able to look for the buying setups. So thank you guys for watching this video. Don't forget to like and share and subscribe to our YouTube channel so that you can be able to see more videos that we are going to upload. So yeah, your boy Chatmaster here, signing out.